Okay, guys, this is going to be recorded. One thing I say at the beginning of all of these webinars is please watch it again as soon as you get it back or get this sent to you because it will make it sink in and stick in your long-term memory. That's first time through, a lot of the nuances will go by you really quickly, but second time through, it should make it stick a little bit better. If you wait, a month or two down the road, it's going to be kind of like learning it all over again, especially if you're new to options. This is a great option strategy to use with bullish market assumption. We've been in a bull market for quite some time. It seems to be a bit of a correction right now, but at the end of the day, a nice uptrend in a particular underlying is good. But the great thing about this strategy is if we are directionally wrong and the market doesn't trade sideways to slightly higher, then we will still be able to make a little bit money on the market going south on us. So that's the great thing about this strategy. And I'll even show you guys some examples of where that's been working out. I've put a couple of these on this week, and despite the fact that I've been wrong on the direction, they're working out nicely. And my name's Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Been trading my own money for well over 20 years now. And I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I am here to help you take control of your finances, manage your own portfolio, and most importantly, take control of your own risk. At the end of the day, if you're paying somebody else out there to manage your portfolio, you're probably seeing in these choppy markets they aren't doing very well. And even some of the biggest names in the business that are running hedge funds are losing money. And the reason why is because they pull so many fees out of those different funds that it makes it very hard to get a return out of them. So if you're doing it yourself, you're going to be saving yourself a lot of money in fees, and at the end of the day, you'll probably be doing just as well as the rest of them. Anyway, I've traded most markets throughout my career, even from the Chicago Board of Trade. I've traded everything from stocks, financial futures, commodities, currencies, and options on all of these products and in all market conditions. I've got to go over this little disclaimer real quick. Any news, opinions, research, analysis, or other information contained here or material provided by ProTrader Strategies and or associate companies or employees is to be constituted as general market commentary and should not be considered investment advice or solicitation to buy or sell any of these securities that we're going to be talking about. At the end of the day, you guys, the reason why we have to go over this is because I can't tell you to go out and buy a specific strategy or implement a particular stock into your portfolio, because it might be counterintuitive what you're doing and it could exceed your risk parameters. So unless we sat down, went over your old portfolio and or I talked to you about what your style of risk is, then I can't really confidently say that something is particularly right for you. So you need to do a little soul searching and see if they are appropriate for you before you implement those. And at the end of the day, do your own homework, and please remember past performance of any trading system or methodology is not necessarily indicative of future results. All right, on to what we're going to be talking about today, which is the ratio call spread. And it's kind of like a long call spread, but we're going to be adding another layer onto this strategy by selling an extra call to finance that full call spread. So if you're familiar with any options, you're going to be basically buying one closer to the money option, which is the call in this case, and then selling two further out of the money calls to finance that. It increases our probability of success, and it also increases our return on capital and several other things that when you're just buying a call spread, you don't get to participate in. All right, this assumption is going to be neutral to bullish, but the way we're going to design this, the reason why it's neutral to bullish is because we would really like it to trade sideways and slightly higher. We don't want it to really exceed our short strikes by very much, but if it does rally up, that's where we're going to make the most money. If it sells off, we're still going to make money. So, you know, you could even say that you can even have just no assumption whatsoever, and you don't really care that it even goes down, because we're going to collect a credit for that, and you will be able to keep that if we are directionally wrong. But the most money to be made in this strategy is if it trends slightly higher. So one thing that this is called is a front ratio spread also. It's front ratio call spread. And there's also other spreads out there. It's called a back ratio call spread. When you're doing a back ratio call spread, you're actually buying two at the money and then selling one further out. That's the back ratio. The front ratio is where you are buying one closer to at the money and then selling two further out of the monies. That's the way we can collect the credit. The other side, you're collecting or you're paying a debit, I should say. One thing, the checklist that we always go through with these, the essentials to success, I like to call them, is picking the right strikes. Now, what we want to do in order to do this, some people like to buy the in-the-money strikes, but at the end of the day, as markets trend higher, when you're buying the at-the-money and trying to finance that, you're really selling an option that is really just out of the money, and I don't like for that strike to be tested. And we'll go over all of the probabilities of being tested on those, and the probabilities of success once we pull up the trading platform. So picking the right duration, I like to pick something that's close to the 45 days. I talk about this in just about every webinar. When we're collecting a credit and we're doing something to collect a credit, we want to see this happen. This is theta decay. We want theta to come out of our options. And this is the bane of an options buyer, because the options buyer kind of has to fight uphill, if you will, to fight off that theta decay. Your market has to move faster than this is decaying. So you have to be directionally right and have the market decay on you with the option buyer. When we're selling this and collecting a premium, we want this to accelerate. We want to see this theta to come out of our options, because that's where we get to collect our premium. And picking the right environment. The right environment is high volatility. With this, anytime you're collecting a credit, you want high volatility, because what happens is volatility pushes up this curve a little bit and holds off theta. So when we're entering this in, or when we're entering into this strategy, we want to have had theta, or vega, sorry, the volatility holding off this theta decay, because volatility pumps up the premium. And then when volatility comes out of those premiums, the theta rapidly, it's like the theta rapidly really decreases. The slope becomes a little more steep, and we collect our premium quicker. So we don't want it to drag out. You know, I don't like to take anything all the way into expiration. A lot of different things go on in here that I'm not really going to touch on, or I'll touch on it, I suppose, which is gamma. Gamma starts expanding, and since we're going to be playing around with close to at the monies, that gamma can really affect us either positively or negatively, depending on where we are. But I don't like to mess around with that, because it just becomes an extra unknown, if you will. So I like to take advantage of this 50% drop right in here. So entering sometime between 45 days is where I usually like to enter or set those up, closest to 45 days to 35 days. So we're kind of right within that wheelhouse of right around that 35 days. If you're doing something on a debit, then you'd be playing out here, because you don't want that to happen. But we want this right here. So we're going to be looking at something, you know, inside of 45 days or closest to 35 days. And I missed one, sorry you guys, but picking the right underlying. But we're on this one right here. Picking the right underlying. right underlying means something that has a lot of open interest, a lot of volume, and has a lot of participation going on in there. We want to see a lot of bid and offers going back and forth, because the more participation that there is, the more willingness somebody's going to give up a penny or two in order to get filled. So if we're in an environment like something like Pfizer, where everybody's heard of those kind of stocks, but those stocks have really wide bid ask. Lowe's is another one. For some reason the options trade better in Home Depot than Lowe's. Lowe's gets pretty tight around earnings, but after that those bid ask and Lowe's for some reason get pretty wide. So I like to stay away from the Lowe's and trade the Home Depot for that reason. So those are things that you really need to look at when you're going into these types of option strategies, especially the more legs you have and the more edge you have to give up on that bid ask. It just is going to eat into your profits, and the more you have to give up to get out. So we want to kind of stay away from it. Oh, and one thing, know your exit strategy before entering the trade. Sorry, moved a little fast for that. But when we're doing this strategy, if the, okay, great question. Trevor's asking, I'm going to go back to picking the right underlying. What bid-ask spread would you suggest? I look at anything that is a $100 stock or below needs to have somewhere around inside of 10 cents to the bid ask. That's my kind of line in the sand. It's got to be around 10 cents. Some of the stocks out there, you will find the more you trade, sometimes you'll have like a 50-cent bid ask on some of the higher flyers that are $250 stocks or whatever, something along those lines. There's stocks out there that you'll find have a lot of open interest, a lot of participation in there, but they seem to have a little bit wider bid ask. So on those, what I would suggest is kind of go a couple of pennies above, or when you're collecting a credit, above what the mid price is, and slowly cancel, replace that order to get filled. Stocks under $100, I like to have it about 10 cents wide, no more than 10 cents wide. When you're getting up into the Chipotle and price lines and things of that nature, you're going to have a wide bid ask. But again, what I'm talking about there is if it's $1 wide on say Priceline, go 25 cents above that mid price, which would be your middling market at 50 cents. Go 25 cents above that, because there's algorithms out there that are going to execute spreads and all kinds of things, and there is a lot of participation in Priceline. So don't really go below mid market on that. So start up a little bit higher and start working it down. Stocks that are in the 20s, I still kind of keep that around 10 cents, because but I'd like to see it closer to a nickel in that regard. Sometimes it's hard, but if there's a stock that's below $50 and it's 15-20 cents wide, I'm probably just going to move on to the next one to see what I can find, because there's plenty of stocks out there that have tight bid asks. And the exit strategy, knowing our exit strategy, I'm going to be looking at getting out of this at about 50% of my max profit potential. I'll go over the max profit here. Max profit on it is going to be our short strike minus our long strike plus the net credit received. So let's just say that we're looking at a stock that's trading around $49 right now. What I'm going to be looking at is buying the 50 call and selling, let's say, the 52 calls twice. So I'm going to buy 150 call, sell 2 of the 52 calls, and I'm going to try and collect, maybe let's say 10 cents. I want to do this for over 0. I'll do it for 0, but somewhere over that. I'd like to see a little bit of credit, so if I'm directionally wrong, I can still keep that maybe 10 cents. So the max profit, let's say we collected 10 cents for this strategy. We bought the 50s, sold the 52s, that's $2, and then the 10-cent credit, $2.10 is our max profit. And that is if the market rallied from 49 to the 52 mark, right there, that would be our max profit. And you pin it there. I'm going to be looking at collecting about 50% of that max profit. So I'm going to be looking to cover this at about $1, somewhere in there if I collect it, or if the max profit is $2. So 50% of my max profit. This market goes against me, or goes south, I should say, not necessarily against me, but south, and I'm directionally incorrect, I'm just going to let it ride into the sunset. That's one of the few times that I will take a strategy to expiration, is just to collect that 10 cents and let it expire all worthless. All right, then on to the max loss. Now, because we are selling a naked short call in a sense with this strategy, our max loss could be infinite if this $50 stock or $49 stock goes to price line levels. Now, what is the probability of that really happening within the next 30 days? Very, very unlikely. I mean, they would have to come up with a cure for cancer or something, right? And in a matter of a week or something. So that is the max loss potential is infinite. I look at exiting at 2 times my max profit potential. So if the example we used, $2.10 is my max profit, as soon as this strategy is costing me $4, and probably $4 is where I'm going to cover that. $4.20 would be 2 times that, but as soon as it's costing me about that much, that's when I'm looking to exit. And pull the plug on it as soon as it gets to your max profit. That goes back to knowing your exit strategy. As soon as you come up with your exit strategy, before you enter this, the trade, you guys, stick to it. The worst thing a trader can do is sit there and go, it's right there at my, exit. I need to pull the plug, and then you talk yourself out of it somehow. Don't allow yourself to do that. Pull the ripcord, get out, move on to the next trade. Because you're playing the probabilities, you guys. That's what we're doing, playing the probabilities. Some of them are not going to work. You just got to close it out. That's, the 1 in 10 that's not going to work maybe. So go back, start churning again. All right, so our break even is that short strike plus our max profit, you guys. So in the example we used, we're long the 50s, short the 52s. Our max profit is $2.10. The short strike is 52 plus the $2.10. Our break even in this example would be $54.10 when the underlying is trading at $54.10. That is our break even. Does that make sense? Because when we're going to get the full $2 for the width of that spread plus the 10 cents we originally collected, that means we can go $2.10 above that short strike before we are no longer profitable. And that is where your loss starts occurring at $54.11. You've lost 1 penny, $54.12. You've lost 2 pennies there. Does that make sense for everybody? I kind of blazed through that pretty quick because I would like to get to the fun stuff. So the trading platform, and this is usually where I go and talk to you guys about the platform and things of that nature. Please start throwing out some, stocks that you guys like to look at. I'll run through it in real time and see how that fits with my strategy. So how do you make this strategy IRA friendly? Great question, Trevor. I meant to go over that. IRA friendly with this one, I usually would go, for instance, if we were going to look at Cummings, I would look at making this friendly by, we're going to look to buy say the 110 calls, now this is 20 cents wide, it is $100+ stock. Usually you'll get tighter markets in this. This is one of those ones where it doesn't really meet it. The at the money seem to be a little bit wide right now. Could be because it's Friday, but you can work this strategy down. And I just did it because it has high implied volatility. The first thing I look for, high implied volatility, I go to the gearbox, add that to my menu, my watch list, and then sort it from high to low. First thing I do is go down these and find the best one, usually starting from high. The only reason why I switched off of it was because GDX is the highest, and that was the first one that I already had it up. So in this regard, we're going to look to buy this one time. So click that to 1, and then hold down the control. This is, I'm going to buy this one because it looks like it's the only one that will allow me to finance it for a credit, sorry. And we're going to make this a 2-lot, and it's a 4-cent credit. So that would meet the parameter. You know, this being as wide as it is, the mid-market is 4 cents. It looks like the natural is -20. I would not go any lower than 0. I'm never going to pay a debit for this, you guys. So I would start it in a little bit higher and work my way down. Like I said, you know, go a little bit above mid-priced. If you don't have a ton of cancel replaces, you guys, in your order deck, you guys are probably giving up a little too much edge. You should always have at least 1, 2, maybe even 3 cancel replaces in order to get filled. And it doesn't mean you have to let it sit there for an hour before you do it. I mean, I usually wait 5-10 seconds and then cancel replace. You got to also think about it. Do I want the penny or do I want the trade? And I usually want the trade, so I'm willing to give up those pennies rather quickly to get filled. All right, so that would fit the parameter. You know, the other than the wider bid ask, if we look at Cummings, and the other thing is I would do this in the sorry, I had this one opened up, so I would go to closer to the 35-ish days because I want this to decay rather quickly. So that's another thing I would do. So I'd have to look at this like actually I'd probably have to go out a little further just to be able to make it so I can get it for a credit, because look, it doesn't look like I'm going to be able to do this for a credit. If I do buy this one, the 110s here, sell the 115s, I'm not going to be able to do that for a credit. So I'd probably then default out further. Sorry, yes, on to the response for making this IRA appropriate. So the thing I do is I usually go out here and I'll buy the first one that I can pay a nickel for. So I would have to say that this would be the strike I could probably get a nickel for. So then I would just buy this as a 1-lot, add that in there, and that will make it IRA appropriate. It is not going to reduce your risk, but you know, because going that much higher, you're probably going to be looking to exit this strategy well before it gets up to the 45 handle. So whenever I'm doing these strategies and I've got to do it in my IRA, I usually go out, buy the first strike that I can pay a nickel for. And remember, it's not going to really reduce your risk. It makes it a broken wing butterfly. Yes, absolutely, Trevor. It's a broken wing butterfly because it's not equal. A regular butterfly would be the 10, 15, 20, and it's a broken wing because we're skipping it out. So you do create a butterfly. And one caveat with this strategy, if you get frustrated with trading butterflies, this one could be similarly frustrating in that regard. But just remember, if you're doing this IRA appropriate, you want it to act like this front call spread or front call ratio spread. Then keep in mind it's not limiting your risk because you're going to be out before then. But it meets the rules. One thing with this, because one thing with delta, and I've done videos on just delta and the different nuances with delta. There's like, most people say there's 4 things that delta tells you. I say there's 5 things, because delta not only tells you the percent of it, percent probability of it being in the money. For instance, a 29 delta means that there's a 29% chance of it being in the money at expiration by 1 penny. And then it also is, you know, a hedge ratio, which means that if you did the 29 delta, it would hedge 29 of 100 shares, and this is an estimation and it does change. It also tells you the probability of being tested. That's one thing I touched upon earlier, and the probability of being tested is 2 times the probability of being in the money. So that means that within the next 56 days, this 29 delta, or this 115 strike, has a 58% chance of the market coming up and touching or testing our strike, and then, you know, coming back off, because at the end of the day, the probability of it being in the money at expiration by 1 penny is only 29%. So the probability of being tested is 2 times the probability of the delta, and that was something that was kind of like a given in geometry on the floor. Was when you were doing your risk parameters, you knew that 2 times the delta was the probability that the market was going to come up and, you know, push your button a couple of times to see how your intestinal fortitude was holding up. So keep that in mind. And when you're doing this strategy, you know, and we were looking at the 10-15s here, know that the probability of the market coming up and testing that 115 strike, which is your short strike that's going to make you nervous, is about 32% of the time. It's going to come up there and really, you know, make you second guess your judgment. But remember, because we've collected that extra $5 going from 10 to 15, and, you know, the 5 cents is nominal at this point, so we'll just say $5. You know that your break even is the 120s now. So the probabilities of the market coming up and testing your break even is, sorry, I was saying that wrong. Probabilities of the 110s to the 115s, the probability being tested there is about 60%. The probability of testing your break even is 32%. Sorry about that. Should I clear that up? Probability of being tested in this strategy, I'll say it again, on your short calls is about 60%. Let's say round it up to 30. You know, 58% is our probability of being tested on our short strike. Probability of being tested on our break even, which is $5 higher than the 15 strike, is around 32%. So remember, our break even is determined by the width of these 2 strikes, which is $5. You add that $5 onto your short call, and that gives you 20. Yes, Francis, this will be archived, so please go back and watch it again also. And what Eileen is asking, what does IRA appropriate mean? In an IRA account, in a regular trading or brokerage account, you get a little bit more leeway. They allow you to take a little bit more risk than in an IRA. The government has determined that we aren't capable of taking that kind of risk in our IRA accounts, so therefore they say you are not allowed to have a short naked call in there. So the way to get around that is to just buy one that is way out of the money, that will probably never come to fruition, and, you know, they only look at it as black and white. Well, you can't be short a naked call. Well, when you buy it 30 ticks above, you know, you're not shorted a naked call anymore, but you haven't really reduced your risk. Gosh, Eileen, yeah, I don't know what the rules are with that in Canada. I'm sorry. I believe the recording, they'll send a link to the recording to your email that you provided. All right, so I went a little long on the probabilities of being tested, but I think that that is very important to know about this, and we always want to do this for a credit. All right, so some people were throwing out a couple. I think I saw Starbucks, so let's look at Starbucks. I know everybody wants to see Apple, so we'll do that one next. So for Starbucks, you know, I can look at this real quick and know that I'm not going to be able to do it. We probably could do the in the money and the out of the money. That might be close. But one thing is IV percent is really low. Now, the reason why we don't want low implied volatility percent in this, because if we are directionally right, or even this goes sideways on us, we can go up here with think or swim and go into theoretical on here, and let me hit reset because I'm sure the date's not right on it. So let's go into theoretical. So let's say the price doesn't change. You know, we go another week or so. Let's say, you know, we go one full week. So we're going to get that theta decay. You can see the theta already happening right there, and everything else is different. Okay, the market just went sideways. But let's say, you know, when we're collecting a credit, we want that theta to happen. We want that price to go down. But what happens if this goes up by 10% implied volatility? I mean, going from 19 to 30 is not unlikely. Look at our premiums. They start jacking up. So that's going to hurt us when those premiums start jacking up, okay? And it's the volatility is going to affect the closer to at the money than it is the further to at the money or out of the money. So keep that in mind, that, you know, that's why these premiums are going to go up more than these will, but we're short two of these, so it's going to hurt us. And, you know, we aren't going to be able to get really far out of the money. That volatility is not going to be affected by a lot, but it will, trust me, end up hurting. As you can see, this went up by 70 cents and this one went up by 60 some odd cents. But keep in mind that the more volatility increases, the more it hurts. And to see something to go from 20 to 50 is not unforeseeable at all. And again, as you can see, that is going to start hurting there because we're short two of these. It's going to be, you know, over $5. That's going to be negative, and we just went sideways. Does that make sense? You want me to show this on, okay, so let me find a good example of one. So people are also wanting Apple. I think Apple has super low implied volatility just off the top of my head. 8%. I mean, that can do nothing but go up. So if we look at a chart of implied volatility, you can see, like, you know, right here is about the mid, and that's up at 50. So Apple really can do nothing but go up. So if you're going to do something in Apple, that would be one of the few times I would say, you know, that's your opportunity to go out and buy options and do it for a debit. I don't like doing that because I think it feels like I'm throwing money away, so I don't, but that's my personal opinion. Can I zoom in on the table? I cannot see well on the numbers. The table here, is it the chart you're talking about there? All right, there's a good one. Rick's throwing out one with a high implied volatility percent. Yes, it does. They just had earnings, so we're good. It's been trending down, so if it has really high implied volatility, I mean, this would be a good one to look at. So let's look at the 28 days on this one. And, oh yeah, this is, you'd be able to collect a really nice credit for this one. So the 60, I like to usually go just outside of the money. Some people like to go in the money. My personal preference is to go just outside the money. Let's see what the it's got really wide bid-ask though, so I'm going to guess that the volume and open interest on it are pretty, it looks like it has pretty decent volume and open interest. You know, that's not a whole lot on a given day. If you just look at Apple, for instance, how much volume and open interest they had on a given day, it's kind of crazy. Even something like Lulu, I think, probably has better volume and open interest, and it has the same, you know, tick size, or it's, you know, valued around the same. You can see it's around 15 cents. But I've always found that Lulu has a lot of participation in there, and you usually don't see, you can usually get in a little above the mid-market. And this one I also have on this ratio spread from the last week's webinar where we did it on a put spread. So despite the fact that Lulu is going directionally against me, since I collected a credit, I'm good with it. So let's go on to, so I would maybe, Rick, I'd maybe put that on my short list if I really love that, or I had a real directional assumption with that particular underlying. But I put it on the short list maybe, and then see if I could find something a little bit better that would fit my parameters a little bit better. So we also got Bank of America. Bank of America usually has really good ones. Low implied volatility. You also threw out Citigroup. The banks have, I thought they were going to start spiking with the threat of an interest rate increase at the next meeting, but they didn't really do that. So all right, so what were some of the other ones? Apple, I think I went through most of everybody's. SPY, that one thing I did fail to mention with indices, ETFs, I will lower that to about 30% for the ETFs and indices, just because you know, there's so many different underlyings within that particular ETF that it smooths it out a little bit, so you don't get a as much of a volatility increase for just given moves and stuff like that. So keep that in mind. So 30% for the ETFs and things like SPY, but you know, it's below that, so I'm going to pass on that one. We're kind of getting close to time, so I'm going to throw out GDXJ, which is the junior gold miners. Now, so it's going to track what gold is doing. It's going to track what, you know, the overall metal side is doing. So this is something that could be looked at. I don't know if you're bullish or bearish on this. I don't really know what my theory is on GDXJ necessarily right now. I'm kind of mixed on the overall precious metals. I'm long silvers. I'm short Newmont mining. You know, so I've kind of tried to make that a little bit balanced, because if we start raising interest rates, I think that the overall precious metals are not going to be as attractive. But the reason why I'm long silver is because I was actually short silver by being long puts, but it went way against me for a while. And then once I got down here, I got to basically break even. I was looking at it to cover this gap. And once it did, I covered it for a scratch. If you watch the daily market commentaries, I talked about that today. I covered it yesterday for a scratch, you know, because it achieved my goal. I said it was going to come down here, cover that gap. It kind of did, even though it gapped lower. And I didn't get the volatility expansion I really wanted at the time. Volatility went against me. So I covered it for a scratch, and then just decided to get long some silver there to hopefully come back up and cover the gap on the upside. So that's the only reason why I did that, just from a technical standpoint. But back to, let's go back to GDXJ. Just because it has the highest implied volatility percent that I have on my watch list, you guys might be able to find something else. What platform do I use? This is Thinkorswim Toss. Yeah, so ER is saying he thinks the U.S. is going to go, therefore silver, and go down. I agree with you. I also think that oil is going to go down too, but it hasn't been really reacting with the dollar as much as I'd like to see. And thanks for joining us, Peter. You came in a little late, but you know, you can always watch it through the archives, right? Okay, so let's go through one more example of this. So high implied volatility, 75 IB%. That meets the parameters. GDXJ has tight bid ask, you know, it's 15 cents, but I will assure you, you can get inside of that relatively easy. There's a lot of participation in this particular one. Now, if you wanted to go out a little further in time, this will get the July options as soon as the Mays roll off. For this one, let's just look at this as an example. I said the SPY is not a good candidate for this one because it has such low implied volatility. So we could be directionally wrong. So when the market goes down, volatility has a tendency to go up. We're selling a call spread. If we collect a credit, we want to see it go down, right? But volatility could expand on us so much that we could be directionally right and be looking at it like we're not making money. And that's why I want to stay away from that, especially with this one. If the market goes down and you get volatility expand on you, it's going to be harder to make money. But once you've already got the volatility expanded, in a particular thing like the gold, you know, the commodities have a tendency to have volatility expand going up, where equities on the way down, volatility expands. Precious metals, volatility expands on the way up. So with this one, we need to collect $2.30. So we go in, we buy a one lot on this. Oops, went too far. Buy a one lot. So we got to try and collect at least $2.30 for this. So we could look at this one, sell those, the 41s. We're only going to get about $2. We sell two of these. We're going to probably be able to get really close. So let's just see what happens, and then we play around with it from there. Oops. And by that, oh shoot, I'm going to have to delete that. One thing with this strategy is you got to build it out, so you got to make sure you get whatever you're doing in the front one first. And with this strategy, guys, if you're used to doing 10 lots in the options, the one that you're buying, make sure that it is half of what you're normally used to. So if you're used to doing 2 lots, do a 1 lot on the one you're buying. That's the way I look at it. And the other thing, don't ever allocate more than 5% of your portfolio to any one given strategy. So keep that in mind. You're asking, do I use any other indicator other than IB when I'm somewhat directional? First thing I look at for an underlying is, okay, IB, if I'm looking to add a strategy today, I go, all right, IB GDXJ is high. It's the highest one I can find. Then I go in and I try and come up with a reason as to why I might want to trade this. Some of you guys have seen I use a lot of market profile. I don't have that one on this one. But market profile is something I look at. I also look at the Fibonacci's, and I also use my econ, basically. I'm in the camp with ER or Peter that I think the dollar is going to continue to strengthen. It's gotten beat up recently. The rest of the world doesn't seem to be doing as well as we're doing, even though I don't think we're doing that well, but we seem to be doing better than most people. So I think that we're going to see some dollar strengthening. And the more our interest rates go up, we're going to be capturing influx of monies here as there's a flight to quality in a sense. Rather than getting negative interest rates, you can get a positive interest. Why not? So I think that that's all going to help our dollar. Then what is going to happen, or help strengthen our dollar? So that's going to, as dollar goes up, gold commodities go down, GDXJ is going to suffer from that. So I would be building my strategy kind of going through it like that. Does that make sense here? Trevor, low volatility stocks, I like to, that's when I go in buying, and I've done webinars on those for low volatilities. All right, great, thanks. All right, so let's go quickly into, before we run out of too much time. So this is one that we're going to look at doing. So 28 days, you know, we don't have that option until Monday, which we could look at it again on Monday. Since this is after, we don't have to necessarily pull the trigger. We can see what it looks like on Monday. But keep in mind, because they're just starting those options, there's not going to be a whole lot of open interest yet, or necessarily participation. So we would go in here, buy this, bending my rule a little bit that it's outside of the 15, you know, it's 15 cents. But there's not a whole lot up here, so we can see. So selling that one, how do I collect $2.30? It's probably going to be close to selling. We might be able to work something where it's not going to work. Oh yeah, well, so hold down. Whoops, let me get this down to 1. So we're going to do a 1 lot here. And then we're going to sell this here. So hold down Control to build it out. I build out every strategy, guys. I know you can go up here and do stuff with these, but I never do. I always do it old school. So I collect 60 cents, all right? So now my break even is going to be the $2.60 added on to the 39 strike, right? So at $41.60 is where we are going to get hurt in GDXJ, which is, you know, going to be an all-time high for the most part. Do I ever leg into it? Great question. No, I don't. Because the other side, the other counterparty, doesn't want to take that risk. So they're not going to be as willing to give up edge, especially, you know, when it's the wider bid ask that we're kind of breaking a rule for here. But they aren't going to give up as much edge as they do if they've already got the, you know, the spread already there. All right. Yes, gold is almost always a dollar play. Yes, great question. So let's look at this on the I did not analyze trade. So this is the risk profile. So as it goes down, we get to keep that 60 cents, right? But as I said, with the unlimited risk to the upside, you know, it's going to continue to go against you as soon as we get above that 41.60 that I said. For some reason, it's making it look like 65. I don't know why. But I thought it was 41.60 is what I came up with in my head. And, you know, your max is going to be right when it's just pinned right underneath our short strike. Okay, see how 39 was our short strike. I don't know why it's saying 39.01, but that's not right. It's going to be 39 would be, because those short calls would expire out of the money and worthless. Do I ever sell 2 different strikes to set up the cost of the buy? Yes, I have, and you can do that. There's nothing wrong with that. I just didn't want to confuse everybody with doing that to In what sense does the ratio spread preferable to spread? What's the rational logic? With this one, well, with this, you know, it's kind of like being short a naked call, right? So that's the closest it is if you like selling naked calls. But by doing it as the spread here, we're increasing our break even by adding that call spread embedded in there. So it's acting like a short call, a naked short call, but you know, with that buffer of the call spread increases our break even, which ultimately increases our profit potential and probability of profits. So that's the benefit of doing this. It is most closely related to being naked short a call because, for one, we are naked short a call. But by embedding that call spread in there, we increase our break even to the upside. So it's not as risky of a trade as just being naked. So yes, it is it is kind of like a bull call spread, but with the extra short call that gives us this for a credit, not a debit. And you get paid either way, Trevor, exactly. The best thing is if, you know, I mean, this is why it's kind of wanky that, you know, it says, you know, we say that it's neutral to bullish. Well, the reason why it's neutral or bullish is because we make our most money if it rallies. But we don't want it to go too high, so it's more neutral in that regard. But hey, we're just as happy as if it goes down because then it's no sweat off my back. I get 60 cents, I'll take that. Why wasn't Apple a good one? Because Apple has like an 8 IV percent. It's probably one of the lowest. So Apple is right here, 7.1 or 7.61. So that's just super low. That would be something where you would be looking at buying options because the probabilities are that the IV is going to expand there. It can't really go much lower. I mean, you got some that are zero, but for the most part, you know, it's so low that there's just nothing, there's no premium in it. So any defensive moves, Peter, with this one, yeah, you know, you could go in if this really started getting close to your, you know, your max loss on it. You could go in and buy the underlying and give yourself long deltas in that regard, which is usually how I would treat this one. As soon as it gets, I'll either just close it and say the probabilities beat me on this one and close it out, go on to the next trade. But, you know, if I'm feeling kind of stubborn and all of a sudden I think, well, you know, it's going to make a quick move because it did something, you know, whether it's a technical thing or, you know, I hear some news that just came out, you know, buy the rumor, sell the fact. Maybe there's some kind of rumor that just came out. You buy that, buy the security or the underlying, let it rally up, sell out of it, and hope that it comes back in that regard. Would be a way to do that. But then you're starting to really trade. Can you, yeah, I did one on, can I name some of the low IV webinars? Yes, I did them on long calls, long puts, and the spreads in there. But I almost always do it from the short side. Peter says, good, thanks. I get scared once these are on. Better not to fight the move. Yeah, I'd rather not fight the move. If it's looking like it's changing directions, I just pull the ripcord. As soon as you second guess it, pull the ripcord, you guys. If you're still confident in your assumption, you know, that's when you can let it play out. But as soon as your assumption changes, get out. First inclination for that matter. But having said that, one of the biggest locals on the floor one time. I was talking to him, and he told me, he was like, Eric, I was like asking him about this trade, and I was, pretty sure the Fed wasn't going to raise rates and then in 2 months later lower rates, which was what the probabilities were telling me, and the banks were just jamming it against me. And I just went to him and was like, hey, Bo, what should I do about this trade? I know I'm right on it. He was like, he goes, Wolf, he goes, the trade that makes you the most nervous is the one that's going to make you the most money. So always keep that in mind. Words to live by. You're always going to get nervous, and those are the ones that are going to make you money. Yeah, I'm going to go over that right now, Trevor, on the website. So that would be the risk profile on that. Always try and do this for a credit, just to wrap it up. Remember, your probabilities are your probabilities are your probabilities. I can't stress that enough. And that will help you sleep better at night, as if you guys know those probabilities, especially being tested. Just look at that and hold solace in that. That's the probability upon inception. Those will change as the market trades up there and test you, but remember what your initial probabilities were when you got in there. Yes, you can do this on the put side as well, and you can do it further out of the money as well. I usually like to get in closer to get that quicker move, but you could do it where you came out here and did these for the credit. For sure. Is make sure the further you go away, though, you're making at least a credit that is covering your commissions too, because you're decreasing your probabilities of being right, remember? So keep that in mind. I like my probabilities of being right, on that particular strategy. All right, so that's about it. If I've, Trevor's asking why do they call me Wolfman? That was something that Joe Kernan and Carl Cantonius came up with. I don't know. They just started calling me Wolfman. It stuck. So when back in the day on the floor when I was standing next to Santelli, I had nothing to do with it. I accepted it after a while. Better than some other things people called me, I guess, in my life. No, kidding. So anyway, so that's where that came from on that front. All right. So if there aren't any more questions, this is the special offer, and this is a really good one. This goes into everything, and let me just pull up the actual web page on this. This is the special offer we got going right now. It's for $26, and basically you get all of these different videos. I show you how to set up your trading screen like I do, talk about delta, measure odds of winning, also theta decay, gamma, how that affects your different trades. I also have one on Vega out there somewhere, but market profile, which everybody always asks about, they are very important as far as I'm concerned. You can learn about that and how the market profile works. I usually have a screen up of that, and everybody's asking what all the blue is, but that's what that's all about, and what are options, things of that nature. So you get all of these different videos, and this one's going to be really important coming up. The Fed starts raising rates, and you guys have bonds where you've gone out and bought bonds to kind of balance that portfolio. Bond prices are going to get decimated as soon as they start raising interest rates in people's portfolios, and I go into how much it's going to affect it. 1% interest rate increase will affect the value, the face value of those bonds. Of course, yeah, you hold it for 30 years, you're going to get par for it, but the average person holds a bond for 7 years. So those bond prices, when you go to try and sell those, you're going to get crucified. Anyway, especially the baby boomers, which is sad because they're the ones that have the most bonds. Anyway, and cost of calculating and all of these different videos for that $36. And then one other thing to note, follow me on Twitter, you guys, at Wolfman's blog, because if you watch the daily market commentaries, I late in the day will talk about earnings trades that I'm doing and things of that nature. So I do the videos early in the morning, talk about the numbers, market reactions, where I think the overall equities are going to go for that day. Somebody asked, do I like SPY? No, I'm short SPY and long some other things, but I'm overall delta short in my portfolio because I think there's a bit of a correction to go down and test the 2,000 mark in the S&Ps. But that's my own opinion. You may have something different. And this is recorded, so please go back and watch it, especially if you aren't familiar with options and or this strategy. Yes, I talk about everything, that's part of my essentials of success, is going through and talk about when I think a particular strategy is appropriate and when. So in later webinars, we're going to be drilling down on options components, how to trade them, where I find them, or where I think they're appropriate. And hey, please reach out to us at trading@protraderstrategies.com and give us suggestions, on different webinars you'd like me to see or you would like me to do. So I'm up for any suggestions. And, if you guys are members and things of that nature, if you have a strategy that's going against you, please reach out to me and I will walk you through the steps of what I would do to defend that particular strategy or how I would approach that. Now, I can't necessarily tell you what I think you should do. Keep that in mind. That goes back to that disclaimer in the beginning. But I will tell you what I think I would do and how I would approach it using my rules. And this is that link to the options course, which is also in the chat box there on the side. If you go and click on in the window there should be the link to that same options courses. And talk about strategies when okay. Trevor, we haven't really come up with the next week's topic. We'll get it out to you as soon as I come up with another one. Is buying straddles futile way to trade? Is buying straddles? Yes. I think that is one of the worst strategies, is buying a straddle. That's my opinion. You just need a very quick move if you're buying a straddle. If you think that something is going to make a very sharp move really quickly, then that's okay, and you have low implied volatility because that'll expand, then yeah, maybe that would be the only time. But at the end of the day, it's so hard to predict. It's hard enough to predict market direction over a given time, rather a quick and fast move, because you got to have the move outpace the theta decay that you're going to see, and you're going to see a lot of theta decay in those front or that at the monies. Okay. All right. So yeah, and you can also reach out to us at 310-598-6677. All right, guys. That's all I got for you guys. If you can't take that, take it easy. Have a great weekend, everybody. Thanks for joining.